All right, let's jump right into this explainer. Today, we're cutting through all the headlines and noise to look at the actual, hard data behind a sector everybody seems to have an opinion on right now. We are going to unpack Cousins Properties' second quarter 2026 earnings report. Our goal? To figure out what the reality of the Sunbelt commercial real estate market actually looks like on the ground. And to kick things off, listen to this powerhouse of a statement from their CEO, Colin Connolly. He pointed out that they leased over 920,000 square feet in the quarter, which brings their total portfolio to 92.8% leased. Think about that for a second. That is their highest level since the first quarter of 2020. So right out of the gate, this one single data point completely challenges that popular, sweeping narrative that office spaces are just sitting totally empty. Now, you might be wondering, what kind of real estate are we actually talking about here? Because this leasing success isn't happening in your run-of-the-mill, outdated suburban office parks. Not at all. It's anchored by what Cousins specifically calls their lifestyle office portfolio. We're talking highly desirable, absolute trophy assets located in booming Sunbelt markets. I mean, just picture the gorgeous Austin, Texas skyline. In today's market, location and premium quality are literally everything. To really understand the anatomy of this success, here's our roadmap for this explainer. We're going to hit 5 key areas. Number 1, defying the office slump. Number 2, Q2 financial triumphs. 3, the Sunbelt leasing boom. 4, strategic property transactions. And finally, number 5, raising the bar for 2026. Okay, section 1, defying the office slump, reaching a post-pandemic high. So, behind all these leasing statistics, there's a very real human behavioral shift happening right now. Tenants are migrating toward highly amenitized, ultra-modern spaces. We're talking vibrant, art-filled lobbies, like what you'd see at Promenade Central down in Atlanta. It perfectly illustrates this massive flight to quality trend. Because companies have realized something crucial. If you want employees back in the building actually has to offer a premium, attractive experience that you just cannot get sitting at your home desk. And the proof that this strategy is working is undeniable when you look at the trajectory. Check this out. They went from 90.7% leased in the fourth quarter of 2025, stepped up to 91.9% in Q1 of 2026, and then culminated in that super impressive 92.8% mark in Q2. They are just steadily and consistently absorbing space. Moving right along to section 2, Q2 financial triumphs, unpacking the numbers. Now, as a quick refresher before we hit the financials, we need to talk about funds from operations, or FFO. If you follow real estate, you know this is the absolute gold standard for measuring a real estate investment trust's operating performance. It strips out the noise and gives us a much clearer picture of actual cash flow than your standard net income metric does. Well, their year-over-year growth here is just stellar. Cousins grew their FFO from $117.5 million, which was about 70 cents per share in the second quarter of 2025, all the way up to $124.6 million, or 75 cents per share, in Q2 of 2026. This tells us a really important story. Their high occupancy rate, it isn't just some vanity metric. It's translating directly to bottom-line operational cash flow. But wait, it gets better. Their same property net operating income on a cash basis increased by a really robust 5.9% compared to the prior year. So the big takeaway here is that they aren't just filling their buildings up. The buildings they already owned are generating nearly 6% more cash than they did just 12 months ago. All right, section 3, Sunbelt leasing boom, inside the 920,000 square foot. This specific breakdown is incredibly telling. Out of that massive 924,000 square feet of office leases they executed in the quarter, an impressive 395,000 square feet came entirely from new and expansion leases. That means 43% of their total leasing activity is fresh new damage. It's not just existing tenants reluctantly renewing their current footprint. It proves that real businesses in the Sunbelt are actively growing and, more importantly, committing to physical space to do it. And honestly, when you have this level of fresh demand for premium space, it hands the company immense pricing power. We can see that reflected clearly in a 9.2% increase in second-generation net rent per square foot on a cash basis. Put simply, when a lease turns over, Cousins is able to charge over 9% more for that exact same space than they were getting previously. That is a fantastic position for any landlord to be in. Let's shift gears to section 4. Strategic property transactions, the operational levers. So the management team wasn't just sitting around signing leases all quarter. They were highly active on the capital front. They bought out a partner's 10% interest in a Phoenix property called 100 Mill for $18.5 million. They turned around and sold an Austin Plaza, bagging a $9.2 million gain. And perhaps most crucially, they secured massive liquidity by closing a brand new 5-year, $1.2 billion unsecured credit facility, which actually improved their borrowing spreads in the process. And they didn't take a break when the quarter ended either. They kept right on recycling capital in Austin. They divested 111 Congress for a whopping $208 million, while simultaneously committing $31.5 million in preferred equity for a brand new 199,000 square foot development called Fifth and Walsh. I mean, this is textbook capital recycling, right? You sell your mature assets to fund newer, significantly more profitable opportunities. These precise capital movements are super strategic. They ensure that Cousins Properties remains concentrated purely in top-tier, highly competitive assets. Just look at the striking architecture of 300 Colorado and Colorado Tower in Austin. By deliberately curating a portfolio of modern, heavily amenitized buildings like these, they are perfectly positioning themselves to capture all of that ongoing flight to quality demand we talked about earlier. Finally, Section 5, Raising the Bar for 2026. Upgraded guidance. Because management handily outperformed their own internal leasing forecasts, and because they successfully executed those highly profitable property transactions we just reviewed, they found themselves in a position to confidently take a major step, raising their full-year earnings guidance. First off, they bumped up their estimated net income to a range of between 8 and 14 cents per share for the year ending December 31, 2026. That's a solid jump from their previous, more conservative estimate of 2 to 10 cents per share. But much more importantly for measuring that core operating health, they raised their funds from operations guidance to a new midpoint of $2.95 per share. The management team explicitly noted that their late-stage leasing pipeline is looking very robust and that trophy office fundamentals across the Sunbelt are visibly tightening. So as we wrap up this explainer, this record-breaking quarter from Cousins Properties leaves us with a pretty provocative thought about the future of commercial real estate. When you really step back and look at the raw data, I'm talking the 92.8% occupancy, the 9% rent bumps, the aggressive and smart capital recycling, you kind of have to ask yourself, with these trophy assets visibly thriving across the Sunbelt, is this whole sweeping narrative regarding the death of the office just a myth of the past? It certainly seems like for the right type of building in the exact right location, the office is very much alive and well. Thanks so much for joining me to unpack all this data today and keep exploring those numbers.